Hey guys, welcome back to the Nomad Show. So this episode we're going to discuss about the idea of developing a trading plan. So this is something that some traders may not think about, right? Especially the starter traders who may just be interested in knowing the strategies and how to look at the charts and how to take profits and so on. Right, but I would say after some experience of trading, that having a trading plan can actually put us in a safer state so that we don't over risk our positions, we don't over risk our capital, and we can actually stay in this and in the long run, right? So over here we're going to just talk about a few key aspects of having a trading plan and how it can actually help keep us safe, right, when we are trading. Okay, so the first point here is to understand the steps to actually develop a robust trading plan. Right, so in the first place, we must be very clear what our goals are. So I would say, what are we going to achieve from this, right? Depends on our needs, our strategy, our time horizon. So someone trading in a very short term, such as doing a day trade, who is someone who is just entering the trade and then exiting the position within the day itself, the approach, the mentality, the strategy will be different from someone who is here, who is able to hold for a longer period. So in this case, the goals that we are getting, right? Someone with a shorter term could be that they are just in here for a fast in, fast out approach. And in that case, if they are profitable, then they may be able to withdraw their profits even within the day itself, depending on the brokers and so on. So they can get the money that they have just profited from the market within the day itself. However, if we look at someone who is trading more long term, then they may be fine if the market goes against them, even in the short term, because they are not looking at exiting the position today or even in the next month. They may be looking at closing the position, say, a few months later, right? When the stock or the option has actually gone up substantially and they're able to close for quite a handsome profit. Okay, so in that case, what goals, what target are we looking at, right? Are we looking to write a very major trend, right, in the coming months, or are we just looking for a quick profit within the day itself? So then that will tell us what to do in terms of our trading. Right, so then we are able to see if we can hold. We're able to see where our target profit is, where our stop loss should be in both positions. So then with this developing of the trade plan as well, we must be able to know what's our instrument. So as we mentioned before in a previous episode, the difference between options and stocks can actually be quite stark, right? So we are saying here that it could be quite different in terms of us trading option and also trading shares. So with options, there's an expiration date. So when we are holding on to the contract over prolonged periods, then let's say we are on the buying side, then we are subjected to time decay. Right? So the more we hold, the more time decay we are going to suffer, and the contract will be losing value over time. Right? So in that case, if the contract doesn't get to a certain value, right, before, or let's say the stock price doesn't get to a certain level by a certain period, then even if it does move later on, the time decay will be so major, so serious that the stock price cannot actually reverse any losses that we have made. Right, so in that case, if you are going to hold for a long time, then probably buying shares, right, may be more suitable. But if someone is looking for a fast return, higher returns, a lower capital, then in that case, options may be a more suitable option, may be a more suitable asset. So in that case, having the trading plan, right, also means to define our asset to actually trade so that we know what asset we are going to trade on and how we're going to approach this, so we become more disciplined. We are sticking to our plan and not just randomly trading anything that catches our attention. Then another point to look at when we define our trading strategy, our trading plan, is to actually look at the risk tolerance, right? So in terms of the risk tolerance, we need to be sure how much risk can we tolerate, right? Someone who is trading in the more short term or someone who has a smaller capital size, the risk tolerance will be different from someone who has a larger capital, because with a larger capital, it may be easier, right, to suffer a smaller loss and to recover from it. Whereas someone else who is trading with a smaller capital may not be able to take the same loss and recover from it. In that case, we must be very clear, right, to identify or to define how much risk we can take so that we don't exceed that level. It is important to have this trading plan in place. Now, what's going on to our trading plan, right? What can we actually include in our trading plan? So one thing to include would be in terms of our entry and exit criteria. So this one we'll discuss more when we talk about strategies. But in terms of using different strategies, right? Different strategies will have in place, right, certain predetermined entry and exit points. Okay, so for example, if you're looking at a crossover strategy, right, let's say a shorter term EMA, right, crosses the longer term EMA, to take this as a bullish trend, and upon seeing this trend, the trader may decide to enter into a call position, and this could be seen as an entry point. Then where exactly is the exit point? Right, our exit position could be, let's say, $1, right, below this price that we enter at, or we can set a percentage, right? So we can either set a stop loss of a percentage. We can stop, let's say, when it's just down $1, or we can also, let's say, exit the position, right, with a stop loss. Say when the EMA now reverses and the shorter term EMA is now crossing below the longer term EMA, right? So all these are variables that we have to determine first, because we have many ways of predetermining an exit position. And if we are not clear, if we haven't defined it from the start, then it's very easy for us to hold on to a losing position and have it actually go from having some value left to having no value left, right? Especially if we are buying options, right? Because at the end of the expiration date, if the option contract doesn't hit the strike price, right, or it is out the money, then the contract just goes to zero. So we would have no salvage value, and that is something that we want to avoid. So in that case, it is wiser to have an exit criteria mapped out clearly and to just cut loss, right, even though it goes against our human nature. Next thing is in terms of our position sizing. So how much are we going to spend or to use, right, in terms of our capital for every position, right? So are we going to use 20%? Are we going to use 15% of our capital on every trade? So the smaller it is, of course, it limits how much we can buy and also how much we can profit from, right, every position. But on the flip side, because we are risking a smaller position of our capital for every position, it makes it easier to control the risk. Right? If we just spend, say, 5% of our capital on every position, then even if it goes to zero, right, we are just losing 5% of the overall capital, right? Let's say we have 95% left, right? Then it is easier to recover that 5% compared to if we use 20% for every position, and then now that we have lost that 20%, right, and to use 80% to gain back the 20%, it becomes harder, right, because we are left with a smaller capital to recover a larger capital that we have just lost. So it is important to balance between the risk taking aspect and also the risk averse aspect, right, of trading. So in that case, right, this would be another component. This will be the few key components that will go into the trading plan itself, right? Now, talking about the strategy, in terms of the strategy, it is not so much about how it is in this episode, right? But more like we need to do some back testing first. Okay, so we may come across a new strategy, or we are an entirely new trader ourselves, so we may not be familiar, right, with how the strategy will work in different situations. So in that case, it may be wiser to actually do some simulation trade first, or to do some paper trade first, right, so that we are able to back test, or we are able to test this strategy out. Okay, so backtesting would be that suppose we look at the stock chart, right? Suppose we are using the chart to trade. Then when we go back in time to look at the chart situation, right? Let's say 3 months ago, 1 year ago, and see if we were to apply the same strategy, right, period in that scenario, right, then are we able to exit, or how are we going to stop loss, right, or let's say exit a losing position, suppose it goes against us, right, and then from there we're able to see what would have been done using the previous stock movements. So this could be done looking at just the chart, right? Or if we want to trade the live action, right? Stock movements have not actually happened yet we don't want to risk our real capital, then we can actually use a paper or trading account, right? So from there, we can actually trade and see how this strategy will actually work out. So it is important that if we are going to incorporate this strategy into our trading plan, then it has to be refined to our own needs. So every strategy is presented as sort of a template, right? So when we learn a strategy, it could tell us to do step A, step B, step C, right? But sometimes we may need to modify a bit to our needs because let's say we are afraid to get out, right? We want to hold to a losing position. Or let's say we don't want to enter at the first instance, we want to wait for it to retest, right? So to be double confirmed that this stock is unlikely to, say, move down, right? Even though it's just moved up. So in that case, it is important to do some testing, refinement of the strategy first, right? Before we actually just try it. So in that case, we are more confident with it and we are able to map out, right, our entry and exit criteria. So in that case, our trading plan becomes more robust. Okay, so this will be something that we can actually work towards. Okay, so the last major point I would say is to have some common mistakes that we can actually avoid. Okay, so looking at all the points that we mentioned just now, right, regarding the trading plan and so on. So we want to first of all, not overcomplicate our strategy, right? So first of all, the strategy shouldn't be very difficult to understand, to apply. There is always this balance between having too many indicators and also having no indicators. Okay, so while having some indicators, such as the EMAs, the SMAs, or let's say stochastics and so on, can help us to look at the chart movements in different perspectives. Having too many indicators may also make the whole chart very complicated, right? It may also mess with our analysis, right? Because different indicators may tell a different story, right? So if you're looking at 10 over, 20 over indicators at the same time, for example, then it may hinder our decision making because half may tell us that it's in the overbought position, right? Whereas half may tell us that the stocks are, let's say, oversold, right? Suppose that's the case. So then it's very hard to reach a conclusion, right? So we need to narrow down to that selective 3 to 5, for example, indicators so that we can keep it simple, right? And then we can use it regularly and we can actually test it out first before we enter into the real trades using our real capital. Okay, then also to note that we shouldn't just ignore risk management, right? So we talk about the idea of sizing our position, right? Keeping every position to a certain size of the capital so that it is not over, it is not too big position relative to the whole portfolio. So this is important because again, it is very hard to recover, right? If this is a big position and then there is nothing left after this trade and we can't recover from this, suppose it is a losing trade. Okay, so it's important in this and also to have a stop loss criteria in mind, right? So that we can be sure that if the stop loss is actually triggered, then we are able to actually just exit the position, right, without thinking too much. Okay, so all right, so this is the episode that we have, right, talked about a trading plan. So hopefully you guys enjoyed this episode and we'll be back for the next episode soon. All right, see you guys.